and welcome you with us here on Business Today. I'm Abha Bakaya. Here are the day's top stories. Share indices end marginally lower after a day of heavy volatility. Tata Motors ends 4% lower, is the worst performing Nifty share. IT stocks recover on value buying. PSU banks rescue the rupee from an all-time low of 82.68 to a dollar. Sell dollars on behalf of the RBI. The Indian currency finally closes at its Friday level of 82.32. TCS kicks off results season with an impressive set of numbers, announces an interim dividend of 8 rupees a share, says we'll know what's happening with client budgets in the next 3 to 6 months. IDBI Bank zooms 10% as government says disinvestment to be complete by next September. DIPAM Secretary tells Business Today TV in an exclusive conversation that BEML and shipping corporations sell-off to be completed by March. Adani Group reportedly in talks to buy the cement business of Jaiprakash Power Ventures. Analysts peg the deal at around 5,000 crore rupees. Will help the JP Group trim its debt burden. Buyers return with a vengeance to car showrooms. Dealers record the highest ever sales during Navratri, even higher than pre-COVID levels of 2019. Former U.S. Federal Reserve Chairman bags the Nobel Prize for Economics. Ben Bernanke and 2 others win the top prize and $900,000 for their research on banks and management of financial crises. After a dismal start to the trading day, key benchmark indices ended nearly 0.5% lower. Nifty was 0.43 down, hovering around the 17,200 mark, while the Sensex was down about 200 points lower, that's 0.34%. However, the Nifty and Sensex recouped a lot of their losses by renewed buying interest in IT names and also select auto and banking stocks. TCS in particular was up nearly 2% ahead of its Q2 numbers. Other gainers on the Nifty were Axis Bank, HDFC Life, Wipro and Eicher Motors. Major laggards in today's trade were Tata Motors on the back of a dip in September JLR volumes, Tata Consumers, Hero MotoCorp, Asian Paints and ITC. The rupee closed at 82.32 levels vis-a-vis the US dollar after touching an all-time intraday low of 82.68 to the dollar. Today is Monday, the first day of the week, and just the right time to get our global business editor Udayan Mukherjee's perspective on what the rest of the week will be like for stock markets. Let's listen in.
Well, markets were down a bit today, but wouldn't worry too much about that because it started much weaker and then sort of recovered towards the end of the day. So what the Nifty is doing and the broader market too, to some extent, is basically showing the same kind of resilience that we've got used to over the last many months. I mean, of course, there was a sharp correction from 18,000 Nifty all the way down to 16,800. But we've pulled back since then, 300-400 points, and we are consolidating nicely above 17,000 levels. And this is not to be construed as weakness in the market at all, despite today's short, small blip. The bigger question is how this global cookie crumbles over the next couple of weeks, because the tidings are not great. We have seen over the weekend the low unemployment numbers actually feeding into that feeling that the Fed is not done yet and there will be several more rate hikes before we are done with that cycle. And that is the key thing which takes risk of emerging markets quite completely. So we are still in that kind of a risk-off mode globally. And to make matters slightly worse, crude has bounced back from the low 80s to the high 90s again. So that is not an India positive factor at all. So next few weeks, let's see. I mean, we are just wading into an earnings season. This one should not be too bad, given that we've had some festive tailwinds going into it. So at least this one, we shouldn't have many downgrades coming in. We'll see about the December quarter after that, because chances are that we might see a little bit more weakness in the earnings in that quarter. But this quarter, we should be middling kind of an earnings, and the market will focus on that as well. So we are in that kind of a holding stage in the market, if you will. We're still battling global headwinds, trying to be resilient as we have been, and we are absorbing fundamentals like earnings over the next 2 or 3 weeks. And let's see how we come out of that in what kind of shape by the end of October. But I think 17,000 is a very, very good level to be at. And if you can hold that through this month, October, which has been a traditionally volatile year, I think we should be very happy about it.
Udayan also spoke to Sanjay Mookim, India Strategist and Equity Research Head at JPMorgan, about equity markets and how they look ahead of Diwali. Here are his view.
I've been reading your notes, and you've been striking many notes of caution in your recent strategy reports. So perhaps you could begin by telling us what makes you cautious about the Indian market from now.
Hey Udayan, hi, it's good to be on. Well, there are multiple things you can say about India and Indian markets, I would argue. If you take a slightly longer term view, say you have the patience to be invested for 5, 7, 10 years, then there's a lot going right for the Indian economy. Structurally, there are things which are improving, and we have done research at our end as well to highlight what several of these are: the manufacturing drive, the urbanization that's happening in the economy, the digitization that is driving upskilling, and so on and so forth. And there's multiple sort of positives that you can potentially highlight. However, in the near term, and this is our firm belief, that stock markets do discount what is happening in the near few quarters. In the near term, there are risks that are accumulating on the horizon. And 2 or 3 of these, if I may talk about just to begin with. One, of course, is that the market has been stronger than its peer set across the world. And this is a very strange thing to say that, look, YTD, the Indian market is actually flat in INR terms and down in dollar terms, yet it appears to be one of the best performing in the world. And that's probably a reflection of the challenges that other economies have faced. But the effect of all of this, Udayan, is that India now trades at a significant premium. Even to the S&P 500, for example, we are at a 10-year high PE premium, while the growth premium is at a 10-year low. And on various valuation counts, India looks particularly extended at the moment. The other sort of issue that we worry about is the external account risks. Right? We've seen how reserves for the country have fallen. We see the potential for liquidity to remain tight in the country, and that could drive credit spreads in India higher still. And that the local growth is actually weaker than we think. So these are the 2 or 3 things, combination of high expectations, high valuations, while the macro risks are accumulating, makes us a little bit cautious on the outlook for Indian equities in the next 12 months.
How much of a price leg down are you expecting, Sanjay? I mean, from the reports that I have read of yours, you seem to suggest that a 5-6% kind of a price adjustment will not be enough to bring India down to long-term averages in terms of valuations or premier differences with other markets. Would it be fair to say that even a 10-15% kind of correction from these levels would not surprise you?
Well, you're putting me on the spot there a bit, Udayan. This is extremely difficult to predict, but quantitatively a 5 or 6% correction in prices will not get you down to average P's by any stretch. There are several companies which are retaining up to 40-50% PE premiums from where they were pre-COVID, right? So forget the long-term average, just the December 19 PE. There are several stocks which are 30-40% more richer in valuation. And you could argue that, look, if the whole world is normalizing, rates are normalizing, the economy is normalizing, why do these multiples retain those kind of premiums through COVID? So tentatively, 5 to 6% is certainly not enough to justify turn in valuation arguments.
You spoke about the December and the March quarter probably leading to earnings disappointments, but many of the factors, or the principal factor for some sluggishness in earnings in those 2 quarters could be the base effect, as you mentioned yourself. But the base effect is not a surprise. The base effect is known. So are you therefore suggesting that even adjusting for the base effect, we are in for earnings disappointments as we look past the Diwali quarter?
Yes, and that's the fear. So you are exactly right in saying that these base effects are arithmetical and they should not drive prices. That's just an optical phenomenon there. But what happens is that analysts do tend to get carried away with the strong growth numbers that are being reported now. And we argue that with the base effects, reported numbers will slow, but more importantly, you will probably see earnings misses. And one of the core arguments we make is that if you look at data over the last 10 to 15 years in India, Udayan, every time prices go up, volumes of sales of discretionary goods take a hit. It is invariable, right? It has happened in every cycle inflation leads to lower consumption. It is very intuitive economically as well. We will probably start to see it post the festive season, where this kind of price inflation in an economy which is not seeing very strong real income growth will probably lead to consumption volume slow down to some degree. And that's why you will likely to see earnings misses and cuts irrespective of the base effect, and that could weigh on prices.
You know, traditionally, if you're right in your call on the market, traditionally what would do well are defensives. I mean, and the classic defensives in such downturns have been mostly the IT and the FMCG companies. Good management, good balance sheets, ability to weather shocks. And we saw just a few years ago how narrow the market had become in a difficult phase. I mean, it was a bunch of 20 or 25 stocks which just kept doing well. Are you expecting, I mean, before you answer any questions on specific sectors, do you expect the market to turn as narrow as it had become in 2018 and 19?
Well, I hope not for all our sakes, frankly, because then we'll have very little to do, very few recommendations to make. But the likelihood is that it might, because the breadth of surprises is likely to narrow. To your point earlier, Udayan, and we've done the empirical analysis, in such macro conditions when liquidity is tightening, the rate, currency is moving and so on, the three sectors which have tended to do well, the traditional defensives in India, IT, staples and healthcare, right? We are not that gung-ho about IT, and we can talk about that subsequently. But these are the sectors that tend to do well. If you remember in 2018, as you said, you know, you had such a narrow market that if you owned 10 stocks, you outperformed. If you owned 15, you underperformed, right? The breadth of earnings revisions is likely to get narrower. Therefore, the risk is that you might get a narrower stock performance basket as well.
Okay, let's take it one by one. Let's start with staples. I mean, you know, a lot of people are not very bullish on staples, particularly at current valuations. They say that at the bottom of the pyramid, demand is still not very strong, and as prices rise higher, it may squeeze that part of the market even more. Do you think the defensive characteristics of FMCG will prevail over these concerns, or do you expect it to be a market performer at best, these stocks?
Well, staying true to my framework of looking for earnings surprises, Udayan, at least in staples, I'm not looking for too much of an earnings miss, simply because expectations are not very high. So when I talk of surprises, you're always talking about relative to expectations or what the consensus earnings forecast numbers might be. And given that staples have already been through, let's say, 2 or 3 quarters of weakness, expectations have been set down to what I would think are realistic expectations. The upside risk to earnings possibly comes from lower input costs. Palm oil prices have come off. These companies have taken price inflation. So you might get either a margin surprise or a bit of a volume surprise in these numbers. But at least the downside risk to these numbers seems to be fairly limited to my mind, which is why I think that, yes, they should be defensive in a market that does not do terribly either way in the next several quarters. To flip that, and anticipating probably your next question, is consumer discretionary. Not only are they growing, but the expectations of growth are super high. Right? In an environment where price inflation is high, which could hurt volumes, the bias is to say that for the discretionary stocks, you might actually get a little bit of an earnings miss.
Which brings me to IT. Of course, I mean, we all know about the global headwinds there. But given that these stock prices have been underperforming, do you think current valuations price in some of the risks that are there, or even from these prices, you cannot make a very bullish construct?
So to some degree, the multiples have compressed. But if you look at the large cap IT, then they're still trading at premiums to where they were pre-COVID, right? December 19 being my benchmark, for example. Between 10 to 20% PE premiums still exist in many of these IT companies. A lot of people have become worried about the impact of the US potential recession or what's happening in Europe on the top lines for these companies, but you've not seen the management come out and acknowledge it publicly. You might still get the event of turn down in management tone on top lines. Yes, margins has been, or the concern on margins have been fully understood, but the top line or the extent of top line weakness has not yet been digested fully to my mind, and the valuations, despite the underperformance, are not there yet, which is the reason why we, despite talking about potential risks to the currency, we are not very overweight on IT in our model portfolio.
TCS kicking off results season with better than expected numbers. India's largest IT company has declared a net profit of 10,430 crore rupees in July to September. That's up 11% on quarter. Revenue grew 5% to 55,310 crore rupees. TCS has declared an interim dividend of 8 rupees a share. The IT giant's operating margin, however, has fallen by 1.6% on year to 24%. TCS net added about 9,840 employees in the quarter and reported an attrition rate of 21.5%. It expected attrition to taper down in the second half of the fiscal.
So net very strong quarter. Quarter characterized by good demand resilience across all our markets. We have closed a TCV of $8.1 billion in this quarter. And we see demand momentum across almost all our operating markets. Of course, the environment is challenging, and it requires all of us to remain very vigilant. And I think we have once again demonstrated that our full services portfolio of services and our focus on both growth and transformation as well as cost and optimization inside our service portfolio is very relevant to different customers who are at different points of their own evolutionary journey as they deal with this volatile and challenging environment. I think the results of this quarter underline the importance of this kind of a distributed portfolio of services that we have, and our ability to stay relevant to customers across all cycles of their growth journeys and as they deal with the challenges in their businesses around them.
IDBI Bank shot up nearly 10% in trade today, with the government starting its divestment process. Bids have been invited to privatize the lender by selling 30.48% stake in it. LIC will also offload a 30.24% stake in the bank. The management control of IDBI Bank will also be transferred to the winning bidders. According to the ministry, the financial bids for the bank are expected before March, and the strategic sale is expected to be completed by September 2023. The central government is set to complete disinvestment of at least 2 PSUs this financial year. In an exclusive conversation with Business Today TV, Tuhin Kanta Pandey, Secretary of the Department of Investment and Public Asset Management, said that the government is targeting complete divestment of BEML and Shipping Corporation by March. An IPO for WAPCOs is also expected this year. Additionally, the government is expected to make a big move on asset monetization by notifying the rail land lease policy this fiscal.
We are talking about the much-awaited IDBI Bank disinvestment. In fact, post its announcement in the budget, the government is of course looking at this challenging process, and it was last week that government also released its preliminary information memorandum, and government along with LIC are looking to sell more than 60%, that is close to 61% stake in IDBI. To talk more about this, I am joined by the, I'd say, man on the mission, DIPAM Secretary, Mr. Tuhin Kanta Pandey. Thank you, sir, for joining us on India Today Group. My first question to you has to be that it's been a very challenging process, because we know that it's been one of its kind transaction in the banking sector. Take us through the process and also the kind of challenges that you had to meet.
Well, you're right actually, because if you see that we haven't really done bank disinvestment through a competitive bidding process the way we intend to do it for IDBI disinvestment. This is actually in RBI's list, it's a private bank. The reason is that, it's a company, banking company, not like a statutory bank in other PSBs. Secondly, government had divested a large part of its stake, more than 51%, to LIC some time back. Later on, there were some QIPs, and then which led to dilution of both government and LIC stake, but which is still, LIC with about 49% and government with about 45%. Still together we own about 94% of the bank. So perceptionally, it is still being perceived as, either the government having large share as well as LIC, which is a government organization, having the management control as well. into more like a public sector entity. However, that's going to change because now that we have an EOI, we intend to pass on the management control as well as a substantial equity of more than 60% to the buyer.
Great. And what is the kind of timeline we see, sir?
Well, in timelines, as I said, it is December 16th and then 23rd December for the physical documents and 16th for receiving it electronically. And post which we will have the requirement of the fit and proper and eligibility criteria for the eligible people to be identified, and then due diligence phase and a financial bidding. And our intent is to have the financial bidding before March.
Before March. That still will not get added to the current disinvestment, I'd say, ratio that we have designed, is it?
Well, let us see how it goes, because this transaction also requires a lot of regulatory clearances, and the closing would of course need all of that.
Great. So one question I'd like to ask, because I think the government is also at a stage where in the recent months they had to shell out more than what was designed in the budget. So they are banking big on non-tax revenues, and disinvestment in dividend is one key aspect when it comes to the checks and balances that we are doing. We have a 65,000 crore realistic target that we have set for this year until, of course, March end. Where are we currently on the disinvestment road, and by March, what would you say could be the figure at?
Well, I think disinvestment, as you know, quite a lot depends upon the market conditions and our ability to close the transactions. We also require bidders who also equally cooperate with us and participate within the timelines. And then there are additional challenges of, for example, the real estate, how to take out the real estate business out of the cooperating businesses, which will require demergers, which have got their own regulatory approvals and so on. A process which is going on, for example, in Shipping Corporation and BEML and NMDC and so on. So keeping into view these matters, I would say that we always try and put best foot forward, keeping in view the interest of the government as well as interest of minority shareholders.
And here's what else is making news in the corporate world. Reliance to raise $4 billion in foreign loans. They're reportedly in talks. While $1.5 billion is for the parent company, the rest, $2.5 billion, is reportedly being raised for its telecom arm, Jio. Easy Trip planners, the promoters of the travel website Ease My Trip, have announced a 2:1 stock split as well as a 3:1 bonus share issue. This will result in each shareholder 7 additional shares for each one that they currently hold. The share spiked by around 8% before closing with gains. The Adani Group is looking at cementing its presence in the construction business with another big purchase. According to reports, the group is looking at buying the cement business of Jaiprakash Power Ventures for nearly 5,000 crore rupees. The debt-laden Jaiprakash Power Ventures has a cement capacity of 2 million tons. The Adani Group had recently parachuted into the cement space by purchasing the India business of Wholesome, comprising Ambuja Cement and ACC, for $6.4 billion. It's now the second biggest cement company in India after the Aditya Birla Group. And that's where we leave it on the show tonight. Thanks so much for watching.